Imagine waking up, opening your trading app, and seeing gold down more in a few days than it usually moves in a year. Your stomach drops. Group chats light up. Headlines scream that the party is over. And yet, somewhere else, in quieter rooms with longer time horizons, money is moving in the opposite direction. That disconnect is where things get interesting, because violent sell-offs feel like information. They feel like proof that something must be wrong. But markets are emotional machines in the short run and weighing machines in the long run. What looks like a collapse can sometimes be a transfer of ownership, from people who needed certainty today to players who are willing to wait for tomorrow. Over the past few weeks, gold delivered exactly the kind of move that shakes confidence. A breathtaking drop, fast enough to trigger margin calls, risk reductions, and more than a few existential crises for traders who thought the trend was invincible. If you only follow price, it looked catastrophic. If you follow positioning, liquidity, and incentives, the picture becomes more complicated. And complicated is where opportunity tends to hide. Let's slow this down and walk through what may actually have happened. When an asset rises for a long time, leverage builds quietly in the background. Hedge funds extend, retail traders add exposure, options activity increases, and everyone becomes just a little more sensitive to downside volatility than they realize. Then a catalyst appears. Maybe it's a shift in expectations around monetary policy. Maybe it's a change in leadership at a central bank. Maybe it's simply the market deciding too many people are leaning the same way. Whatever the spark, the effect is similar. Prices fall, leveraged players are forced to reduce exposure, and selling creates more selling. Stops trigger, risk managers intervene, volatility feeds on itself. None of this requires a grand change in the long-term story. It's plumbing. And when the plumbing backs up, price can detach from narrative with shocking speed. Here is the part most people miss. The participants being pushed out during moments like this are usually the most time-sensitive holders. They are the ones who must act. They don't have the luxury of patience. Longer duration buyers don't face that pressure. Pension allocations, reserve managers, strategic asset allocators. They can watch turbulence without being forced to hit the eject button. So the key question becomes, after the fast money sells, who is left standing? Because whoever remains effectively sets the next chapter. Despite the drama, many of the structural themes that supported gold ES rise over recent years appear to have vanished overnight. Central bank demand has been one of them. For a while now, monetary authorities across the world have been diversifying reserves, often with a preference for assets that carry no direct political strings attached. Gold's appeal in that context is straightforward. It sits in your vault. It is no one else's liability. In an era where financial sanctions have become part of foreign policy, that characteristic may matter more than it used to. Another pillar has been the slow, grinding conversation about sovereign debt and fiscal sustainability. Whether one is alarmed or relaxed about it, the sheer scale of global borrowing keeps the topic alive. When debt levels are high, markets tend to assume policymakers will be cautious about allowing real interest rates to rise too far for too long. Assets that historically perform well in lower real rate environments naturally stay in the discussion. Then there is currency uncertainty. Reserve status is built over generations, but confidence can ebb at the margins much faster. Even small shifts in how countries think about settlement, trade invoicing, or diversification can ripple into gold demand without ever making dramatic evening news. None of these forces guarantee higher prices tomorrow, but they help explain why some institutions might view sharp pullbacks less as a verdict and more as a repricing event. Think of it like a crowded theatre where a few rows suddenly rush for the exit. It feels like panic, but if the building isn't actually on fire, others may quietly move into the seats that were just vacated. Now, does that mean the bull case is untouchable? Of course not. there are scenarios that could cool enthusiasm. A sustained period of convincingly higher real yields would change the math. A dramatic improvement in geopolitical stability could reduce safe haven interest. A powerful resurgence in growth that pulls capital toward productive risk assets might leave defensive allocations looking less urgent. Markets are ecosystems. Change one variable and behavior adjusts. What makes the current moment fascinating is the tension between short-term fear and long-term conviction. You can see it in flows, in analyst notes, in the way dips are discussed not only as warnings, but also as potential entry windows for strategic capital. That doesn't happen in dying markets. It tends to happen in contested ones. Another element worth appreciating is psychology. After a huge rally, investors become accustomed to upward motion. Volatility feels unnatural, even though it is perfectly normal. When the first deep correction hits, it can feel like betrayal, as if the asset broke a promise it never actually made. But bull markets rarely travel in straight lines. They advance, exhaust, reset, and rebuild. The resets are uncomfortable precisely because they restore two-way risk. And two-way risk is necessary for trends to continue. If everyone is already all in, who is left to buy? Flushes answer that question. The recent move also serves as a reminder that leverage is a magnifier, not a strategy. It can accelerate gains, but it can just as quickly force exits at the worst possible moments. Participants with lower sensitivity to short-term volatility often inherit positions from those who cannot tolerate it. From a distance, that transfer can look brutal. From a structural perspective, it can look like maturation. And this is why large financial institutions can remain constructive, even while acknowledging near-term turbulence. Their models tend to operate on multi-year horizons. They are less concerned with whether price zigged this week and more focused on how macro regimes might evolve over cycles. Again, that perspective may turn out to be right or wrong, but it is internally consistent. So where does that leave everyone else watching the chart flicker in real time? Probably with more nuance than the headlines allow. A collapse in price does not automatically invalidate the broader thesis, just as a rebound does not confirm it. Both are pieces of information. Neither is the whole story. What seems clear is that the gold market has entered a phase where narratives about debt, policy flexibility, currency architecture, and geopolitical risk are colliding with the mechanics of leverage and liquidity. When those worlds meet, volatility is not an exception. It is the rule. For patient observers, that can be unsettling. For historians of markets, it is familiar. The coming months may tell us whether this episode was merely a violent reset within a larger structure or the early signal of something more profound. Either outcome would fit somewhere in financial history. But if nothing else, the divergence between panic selling and institutional interest suggests that beneath the surface, conviction has not disappeared. It has simply become quieter. And in markets, quiet conviction can be a very powerful thing indeed. A market doesn't fall 20% in a blink without leaving emotional damage behind. Screens flash red, commentators grow louder, and suddenly what felt inevitable starts to feel impossible. Confidence evaporates. People who were celebrating new highs a week ago begin wondering if they misunderstood everything. But here, as the twist history teaches again and again, the most violent moves often tell you more about positioning than they do about truth. Because while one group is being forced out, another group is quietly stepping in. And that tension between urgency and patience is where the real story lives. In the aftermath of the drop, a curious thing happened. Instead of backing away, many large institutions reiterated or even lifted their long-term expectations for gold. Research desks at major banks circulated notes outlining scenarios where prices could remain elevated or grind higher over time. not promises, not guarantees, just frameworks suggesting the forces that drove the rally might still be in place. When professionals do that immediately after a plunge, it's worth pausing. They know how this sounds. They understand optics. So if they are willing to look through the volatility, it usually means their thesis is built on something deeper than last week's candle. To understand why, you have to separate two different markets that trade under the same name. There is the gold of headlines, the tick-by-tick arena of futures traders, algorithms, and leveraged bets. That market can move brutally fast. It responds to expectations about interest rates, currency strength, liquidity, and sometimes simply to who is leaning the wrong way. Then there is the gold of reserves, asset allocation models, and multi-year planning. That market moves slowly, deliberately, and with very little drama. Participants there are less concerned with tomorrow morning and more concerned with what the world might look like 5 or 10 years from now. During sharp corrections, the first group often has to act. The second group often gets to choose. If leverage was reduced during the sell-off, and it frequently is during episodes like this, the ownership mix may have shifted toward investors with longer horizons. Many professionals would argue that this can create a sturdier foundation, even if the process of getting there feels awful in real time. It's a bit like turbulence on a flight. Unpleasant, sometimes frightening, but not necessarily a change in destination. So what are these longer-term thinkers looking at? One major theme is the behavior of central banks. Over recent years, a noticeable number of them have shown interest in increasing their gold holdings. Motivations can vary. Diversification, liquidity preferences, historical precedent, domestic politics, all of it can play a role. But the common thread is simple. Gold is an asset without a corporate issuer or a foreign government standing behind it. For institutions that worry about counterparty exposure, that quality may carry weight. Another factor is the ongoing debate about fiscal sustainability in large economies. Investors don't need to predict catastrophe to acknowledge that high debt levels can influence policy choices. If markets believe authorities might lean toward keeping borrowing costs manageable over time, that expectation alone can shape demand for assets traditionally viewed as stores of value. Currency dynamics add another layer. Even modest uncertainty about future purchasing power can nudge portfolio managers toward diversification. It doesn't require panic, only probability. And then there is geopolitics, which has a habit of simmering until it suddenly doesn't. In periods where alliances shift or trade relationships look fragile, interest in neutral reserve assets often receives a second look. None of these elements ensure a straight path upward, far from it, but together they help explain why some institutions may interpret a correction as a repricing event rather than a verdict. Now, let's talk about another piece that tends to surprise people. In powerful trends, the assets linked to the commodity, particularly mining companies, always move in lockstep with the metal itself. Operational challenges, political risk, management decisions, and simple equity market dynamics can all interfere. But when investors begin to believe high prices might persist, attention often rotates toward profitability and cash flow potential. That possibility can attract fresh analysis, new capital, and occasionally renewed enthusiasm. It doesn't happen automatically, and it doesn't happen on command, but it is part of the ecosystem professionals watch. Still, every compelling narrative deserves its counter-arguments. If real interest rates were to rise meaningfully and stay there, the relative appeal of non-yielding assets might diminish. If global tensions cooled in a durable way, safe haven demand could soften. If confidence in major currencies strengthened, some of the urgency behind diversification might fade. These are not wild ideas. They are realistic alternate paths. Serious investors keep them on the table at all times. What makes the current moment so fascinating is that, despite those risks, many institutions appear comfortable maintaining constructive outlooks. That doesn't mean they are certain. It means, based on their models, probabilities may still favor resilience. and probabilities are what markets trade on. There's also a psychological component that rarely gets enough airtime. After a huge advance, people start to believe volatility is abnormal. When it returns, they assume something broke. But from a historical perspective, sharp pullbacks are often the mechanism that allow trends to continue. They reset sentiment. They reduce crowding. They remind participants that risk is real. Uncomfortable, yes, but sometimes necessary. Zooming out even further, gold AS rise over the past several years can be read as part of a broader conversation about trust. Trust in policy, in institutions, in the durability of financial arrangements that many investors once took for granted. When trust wobbles, even slightly, interest in assets perceived as independent of those systems can grow. Whether that shift proves temporary or long-lasting remains to be seen. Monetary history is full of regimes that looked permanent until they weren't, and full of alarms that ultimately faded. Humility is essential. What we can say is that a dramatic sell-off did not automatically erase the motivations that attracted large buyers in the first place. If anything, it clarified who is participating for the long haul and who was there for the ride. And that distinction matters, because markets are ultimately shaped not just by opinions, but by staying power. The weeks ahead will test conviction on all sides. Prices will move, narratives will evolve, and new data will challenge old assumptions. That's the nature of the game. But if you listen carefully beneath the noise, you can hear something steady. A debate about the future architecture of money, about resilience, about optionality in an uncertain world. Gold happens to sit right at the center of that debate, which is why, even after the shock, so many eyes remain fixed on it.